Well, good afternoon, everybody, and I want to thank you for joining us for our Key Investors Roundtable series. We're pleased to bring these type of opportunities to some of our key partners and key investors, and I'd like to thank you for joining us. I think as we look at the time and everything we're living in here, the federal officials have indicated that they may have to get innovative in how we revive and sustain and bring our economy back online. And we're certainly pleased to have Charlie Evans, President and CEO of the Federal Reserve, the Bank of Chicago, here with us today to give us a little bit of a high-level economic outlook and discussion. So Charlie served as President and Chief Executive Officer since September 2007. And in this capacity, he serves on the Federal Open Market Committees and the Federal Reserve System's monetary policy-making body. Before becoming President, Evans served as Director of Research and Senior Vice President, supervising the bank's research on monetary policy, banking, financial markets, and regional economic conditions. His personal research is focused on measuring the effects of monetary policy on U.S. economic activity, inflation, and financial market prices. Just a few items before we begin the program. We are going to leave time at the end after Charlie's remarks for Q&A. We do ask that at the bottom of your screen you utilize the questions and answer icon. And you can submit those at any time during the discussion, and we will get to as many of those questions as we can at the end. And Charlie, I want to thank you for taking time and joining us today. And I'm going to minimize my presence on the screen, and we're going to turn it over to you. Thank you.
Okay, great, thanks. Let me start by expressing my deepest sympathies for all of those who have been touched by the coronavirus. We're all aware of the situation in Michigan and the hardships you face. Our sincere gratitude goes to the healthcare providers, workers in essential services, and all of the others who are doing so much to get us through this difficult time. I'm glad to be here today and share my views on the U.S. economy, the Fed's initial responses to the crisis, and some of the challenges that lay ahead. Of course, as usual, the views I'll express today are mine and do not necessarily reflect the views of the Federal Open Market Committee or others in the Federal Reserve System. I don't need to describe the stay-at-home restrictions and shutdowns in non-essential activities that have been proclaimed around the world in efforts to reduce and hopefully stop the spread of the COVID-19 virus. We're all living it and seeing the enormous effects on the economy. One could ask many questions about where the U.S. economy is headed. I want to preview three that I keep coming back to when thinking about this. First, when will workers feel safe in returning to their jobs when non-essential businesses call them back? What will make them feel secure? What will safe operations look like? Second, how fast will consumer confidence return as households venture back to more on-site retail shopping and other activities? For example, when will leisure travel resume? When will destinations such as Disney World reopen? What will it look like, and what will the public's reaction be? Third, what economic sectors will be the source of strength as the U.S. and global economies recover? Just a few months ago, the primary source of strength in the U.S. was the consumer, with activity fueled by an exceptionally strong labor market and record low unemployment rates near 3.5%. Who will perform this role next? There are more questions and answers, but I'll make an effort at addressing a few. Let me start with the status of the U.S. economy. The national data show that a sharp deterioration in economic activity began in March. Last week's initial report showed GDP contracted at an annual rate of 4.8% in the first quarter. This illustrates the quick and large effect that mid-March's stay-at-home policies had on the U.S. economy. Over the quarter as a whole, real personal consumption expenditures fell at a massive 7.6% annual rate. The quarterly decline entirely reflects a huge drop in spending in March, which was by far the largest monthly decline on record going back to 1959. Business investment also fell sharply in the first quarter, and the data on housing starts and sales for March indicate a sharp contraction is occurring in this sector as well. Measures of consumer confidence fell sharply in April following a steep decline in March. The April drops were the largest monthly declines ever recorded. In labor markets, weekly initial claims for unemployment insurance surged to record levels that were many times higher than any previously recorded. Between March 15th, around the time that the first social distancing measures were taken, and May 2nd, Over 33 million workers initiated unemployment insurance claims, far exceeding the flows seen at the height of the Great Recession. By April, the unemployment rate had shot up to 14.7% from only 3.5% 2 months ago, before the onset of the crisis. And as you know all too well, there's been a lot of hardship here in Michigan. The healthcare situation has been very difficult, and economic activity has been hit hard as the automobile industry shut down production and many other businesses closed their doors. But on a slightly more positive note, auto production lines will begin to reopen on May 18th. And at the national level, though still very low, daily and weekly indicators of consumer sentiment and spending have risen a bit recently. Some of the gains appear to reflect support to households from payments made through the CARES Act. Now let me turn to the near-term outlook. Clearly, the second quarter will show a huge decline in GDP. This figure shows a range of recent projections made by a number of highly reputable private sector forecasters, and these forecasts are between -25 and -40% at an annual rate. Looking ahead, the policy objective of stay-at-home orders is to reduce the spread of the virus. The shutdowns have large repercussions on the economy, but once the public health threat has been reduced, the declines in business activity and employment should be short-lived. For a baseline outlook, it's reasonable to assume a legitimate return to growth in the second half of 2020 and into 2021. With sufficient progress on testing and tracing, we should see a slow but steady decline in social distancing that will allow more businesses to reopen and consumers to go about their daily lives with a greater semblance of normalcy. The pickup in activity will likely be slow at first because of continued social distancing and other safety precautions. Many forecasters have this as a baseline. At the end of this year, the median of such a group still had the level of GDP about 5% below where we were before the crisis, and the unemployment rate at about 9%. But other more pessimistic scenarios are also much discussed. For example, a second wave of the disease could necessitate reshuttering activity like in March. Or bankruptcies could be larger and more widespread, leading to further destruction of employment and business relationships, or some combination of these scenarios and other difficulties. But uncertainty is high, and there are so many potential difficulties at this still early stage. The likelihood of the baseline scenario may only be a bit higher than that of the more pessimistic possibilities. But let me describe some business reports that support the baseline outlook, which is more positive. Before each FOMC meeting, I speak with my directors, a number of CEOs with a large business reach, and several advisory groups. Everyone is challenged. Even so, a number of manufacturers describe their substantial and largely successful efforts to operate safely in today's demanding environment. One perspective came from a large manufacturer of durable goods. Their product lines qualify as essential business, and they've been in continuous operation in the United States and throughout the world. My contact described how their workers wear face masks and safety glasses and are separated by plexiglass if they must work in close proximity. Areas where there's close personal contact undergo intense disinfection. The firm also has a health center where workers can be screened and tested and where contact tracing and quarantining are coordinated. I heard of similar efforts from other manufacturers, including Michigan's automakers. These responses to the public health challenge on the factory floor give me hope that, when the time comes, others would be able to scale up production as well. Their success, and the success in making workers feel safe on the job, is an important marker on the roadmap to recovery once stay-at-home orders are relaxed. Such investments in worker safety are clearly necessary. But of course, they're also costly and they reduce productivity. And so this adds to the financial pressures firms are experiencing. Therefore, another key factor to recovery will be the availability of financial resources to sustain and expand these efforts. Unfortunately, such work arrangements with social distancing may be needed for quite some time. This will likely depend on the success of testing and tracing and perhaps be needed even until a vaccine is available. In this environment, policymakers, business leaders, and households will need to adjust our thinking about what sustainable economic activity looks like on a quarter-by-quarter basis over this period. For example, it appears likely that some businesses will be able to operate safely at a reasonably high level of activity, like the factories I described. Other business sectors, for example, travel and leisure and hospitality, probably won't be operating at anything close to pre-crisis levels. More than half the states have begun to partially reopen their economies. The relaxing of stay-at-home policies is a bold decision, but with pretty high risks, in my opinion. In any event, we will learn something from these experiments. For example, the kinds of activities households and businesses feel comfortable in pursuing. We will see how well their confidence and willingness to spend holds up throughout this process. Let me finish with a word about economic policy. Congress, the President, and the Federal Reserve swung into action quickly in order to provide relief to households, unemployed workers, businesses of all sizes, and financial markets. Fiscal policy has provided unemployment benefits, paycheck protection support by the Small Business Administration, direct payments to most households, and targeted support to some industries hit hardest by the pandemic crisis. The Federal Reserve quickly rolled out some programs from our 2008 financial crisis playbook in order to improve financial market functioning and thus support the flow of credit to households and businesses. Then, with the support of the Treasury's fiscal backing, the Fed designed and implemented several new so-called 13.3 programs. These are programs that, under Section 13.3 of the Federal Reserve Act, can only be implemented during emergency circumstances, like now, and only with the approval of Treasury. The Fed is providing additional help, including money market lending support, corporate credits, and Main Street lending, within the restrictions placed by the Federal Reserve Act. Accordingly, we can only provide lending and must be careful to avoid losses. There's some indication that these policy actions are beginning to cushion the blow from the pandemic on households and businesses. Still, we face significant challenges ahead, first on the health front and then on the economic front. We must do all we can so that economic activity can resume once it is safe to do so, and focus our efforts on returning to prosperity as quickly as possible. Households, businesses, state, local governments, and federal policymakers all have a lot of work to do to get the nation back on its feet, and we will keep at it. Thanks very much. I'm ready to take questions.
Ellie, thank you for that. And we do have a couple of questions in the queue here. And again, I would encourage anyone with any questions to go ahead and use the Q&A button, or the Q&A button at the bottom of your screen. Let's start. You had mentioned the stimulus package and directed at small businesses and households. Do you anticipate or think Congress will act and bring more dollars available through the Paycheck Protection Program or other forms of funding to small businesses?
I think that's a good question. I think it's likely going to depend on the success of a bunch of return to work policies. I suspect that there will be a continuing need for fiscal support. I wouldn't be surprised if continuing programs like that a little bit longer could be helpful, but we're definitely seeing a number of states implement relaxing their stay-at-home orders, more returning to work, more retail shopping, and all of that. And it's going to depend a lot on the spread of the virus and whether or not we can contain that. So, I'm optimistic that Congress and the President will, step up and provide the type of continued relief that is necessary to get us back on the road to prosperity.
Fantastic. Thank you with that. What about, there's a lot of talk about states and local communities. And I know even here locally, a number of our local communities are struggling, pre-COVID. And what's it going to look like coming out of that? Do you see Congress acting in anything and helping states and local municipalities?
So I agree that, everybody's going to be struggling. Businesses are struggling, households, state and local governments are definitely struggling. Tax revenues are greatly reduced. They've been delayed if they were linked to the federal income tax, and just funding for those activities where states have to run on balanced budgets. And so it's very important, I would say, for all forms of employment to return to as close to normal levels as possible. And I think the state and local governments are important employers in all communities, just vastly important, providing safety net protection and all the kinds of services that we all need in order to, keep our communities and businesses going. So I think it's very important that the federal government, strongly consider supporting, all 50 states and localities, because it's just fundamental to keeping things going.
So, Charlie, the next question we have in the queue here is, what are you hearing about consumer confidence today? Do you have a sense of what consumer spending might be as the year progresses?
Well, I think that's an important and difficult question. Consumer confidence has fallen dramatically. Now, sometimes that seems like it's correlated with reductions in financial asset prices. The stock market has come back some, and many states are slowly relaxing stay-at-home orders, and people are going out and about with better weather, and so perhaps that could improve sentiment a little bit. But I think it's going to depend a lot on how successful these efforts are, and I think everybody's going to do it a little bit differently. Some communities are struggling more than others. And so just seeing whether or not the virus can be held off through these careful social distancing, but still going about and doing everybody's jobs in retail will be very important. I think that if there were continued confidence that we could go about doing things like that and, still, assume some semblance of a return to normalcy, then that would probably improve confidence greatly.
Sure. How do you feel about negative interest rates as a policy tool?
Well, negative interest rates, that's, we always thought of that as a theoretical kind of idea. I mean, who could possibly imagine that, somebody would charge you for putting your money, in an account of some sort, and banks would be charged for that. But, after the 2008 financial crisis and the very slow recovery in Europe and other foreign countries, a number of central banks did turn to negative interest rates, the idea being that they were trying to incent even more borrowing, even more measured risk-taking on behalf of businesses and consumers to spend and continue their economies going. In the US, we didn't pursue those policies, partly because we were doing an awful lot of asset purchases. I think that we had committed earlier that we would provide monetary accommodation to support the economy in strong measure, and we had the confidence of the American people. And I think other foreign central banks were slower, and they probably had to resort to some of these things. Now, in a very low interest rate environment where you think you need to do more, one policy tool would be negative interest rates. I would say that, at best that would need to be studied more carefully. I frankly think the mechanism for how that actually benefits economies needs to be understood, and the, differing incentives that it provides for economic actors. So, at best we'd have to study it more, but I don't anticipate that being a tool that we would be using in the US.
Sure. Thinking about Michigan, is your forecast more positive than negative?
Well, manufacturing is very important for Michigan, and the automakers getting production going again, and all of the jobs that are related to that through suppliers and the consumer activities that the household incomes support there. So I think manufacturing is very important. In other parts of the state, that also is important. I was definitely encouraged as I talked to more business leaders about how they are navigating safety carefully on factory floors and being able to maintain pretty good production rates, but they have to be very careful. So I think that bodes well. So, I think that, Michigan, like so many Midwestern states, fundamentals are very good, good workforce, good entrepreneurial spirit. There's no reason why, they can't navigate that fairly well. But I think keeping the coronavirus at bay and not letting it continue to spread needlessly has to be a continuing concern for everybody.
Sure. And you mentioned that in your remarks, and that is, how do you build that trust back with employers and customers? Maybe expand on that just a little bit there, because I think that's such a critical piece. And I think what we're hearing right now from a number of our employers as well is, how are you providing that safe work environment?
It's a great question, and I'm learning from everybody that I talk to, and we haven't even opened things up. Certainly in Illinois, very carefully, they've, allowed people to go out to golf courses in twos and things like that. I think when you go out to a restaurant and actually sit down and you see if there's spacing every other table, I guess I have seen reports that Waffle House in some areas, they've got every other booth is closed, and they've got some kind of plastic around, other parts of it. I don't know how people are going to feel about that, but getting out and socializing is something that everybody, kind of longs for, and you can understand why people are out when the weather is good. We're just going to have to see how it plays out. I think sharing the best ways to go about making people feel safe in the retail stores, selling furniture, whatever it is that you're doing, and sharing that and learning from that so that we can all do as much as is possible.
So similar question is one that was earlier. So your analysis, when you think about both state and local municipal budget services, but really thinking ahead from maybe real time now, and thinking into 2021, 2022. Any thoughts on the municipal budgets?
I think everybody's going to be challenged. I think the lower level of activity leads to lower tax revenues. I think that's a real challenge. Lower levels of employment, and the hope in the early days of the shutdown is if we could sort of shut down the economy for a brief period of time, and if the virus sort of was under control so that we could open things up, then we would have had a very short-term period of reduced activity, and then we could go back to more normal levels. So if it was like 3 months shut and then after that you continue back, you can imagine that state and local governments with the lower tax revenues but continued revenues coming in after that could maintain good employment levels. And as everybody maintains employment levels, then incomes are good, consumers go out, they spend, businesses then have a reason to expand. And so I think keeping everybody engaged is really important. State and local governments are an important part of that too. It's just a sizable part of our economy, and there are multiplier effects when everybody is out there working and earning dollars as income.
Yeah. So another question around, interest rates, and I think when your view on that over the next 18 months, and the second part of that is, you can't lower your base rate much lower, can you? So I think it almost kind of gets back to that one on the negative interest rates as well.
Yeah, one challenge that we've been facing for quite a long time, last 10 or more years, and I used to speak about this quite a lot, was that trend growth rates around the world are a lot lower than they used to be in the 80s and in the 90s. And with lower sustainable growth rates year after year, we haven't updated it yet, but it was just late last year that my guess as to what repeatable real GDP growth year after year was about 1.75%, just a little under 2%. With that comes lower interest rates in general. That's what the theory says. And around the world, interest rates have been a lot lower. So we start off with less monetary accommodation that is possible in response to downturns. And now we're in a big downturn. And so we very quickly adjusted our short-term policy rate back to zero. I anticipate we're going to be there for quite some time. I think we need to continue the accommodation, let financial markets work, get the economy back up on its feet. And I do not see inflation being a challenge. That's an environment where there's really no reason to increase borrowing costs to anybody, which would dampen the incentives to go out and spend, invest, and we really need more of that. So I anticipate that interest rates are going to be low for quite some time. Now, of course, counteracting that a little bit is the fact that the federal government properly is engaged in dramatic deficit spending to provide relief for households and businesses. As the national debt goes up, the government borrows more. It's still the case that long-term 10-year treasury rates are under 1%, well under 1%. So this is the time to go out and borrow and engage in activities which have very high social rates of return in order to benefit the American people.
Sure. Have you heard any discussion on the Paycheck Protection program and those loans and the expense period being extended from 8 weeks to 12 weeks? I know we hear from a number of small businesses that it's challenging, I think, to keep the staffing levels productive until the economy comes back more online a little bit more.
So I think that's so I think that's important. I think, however policymakers can, I think we need to make it easier for businesses, consumers, and households to make the right decision for their public health safety, so that if we need to go a little bit slower, we can do that to make sure that the virus spread is minimized as much as possible and people are safe. So that's one of those cases where you could imagine that Congress and the president need to swing into action and extend the Small Business Administration, the length of that protection. Similarly, unemployment insurance compensation is an alternative to that, which is easier for people really to apply for. So they both have the same effect, which is to support households during a period of time before it's completely safe to go back. I think we need, policymakers in Washington to be thinking very carefully about, what's best for, the American people, the economy, businesses, households, and that could involve extensions like that. And the Federal Reserve is prepared to do everything that we can in order to also support the continued growth in employment.
Sure. So here's maybe the $1 million question here is, kind of looking into the future, how do we pay for all these programs?
Well, at the moment, borrowing costs are really very low. So we're able to borrow and we're going to be able to service that. My expectation is quite easily for quite some time. I think, we're going to have to think about, what that means and what the future of the economy looks like. I think the U.S. economy is going to continue to look very strong around the world. People are going to continue to want to invest and provide their savings, to the U.S. debt. I think it's, very safe, all of that. As I said before, when the interest rate is so low and then you engage in investment activities, investment in people that has a high social rate of return, it's sort of, if it doesn't pay for itself, it's a very, very good investment. I also think that this is a way in which we sort of share the losses across all Americans, better. This was one of those instances where nobody could possibly have insured against this virus kind of outcome. Nobody would have offered you that insurance. You wouldn't have wanted to pay for it. It's only once every many, many decades, 100 years or something like that. So this is just one of those cases where it makes sense for the federal government to come in and help out everybody so that, nobody is disadvantaged needlessly, because it wasn't anybody's fault, that type of thing. So I think it's necessary. We are going to have discussions about the level of debt. Level of debt around the world is going to be a lot higher, and we're just going to have to work through that.
Sure. Has there been any discussions about allowing banks more flexibility with allowing borrowers to more easily go interest only with their loans? And this would be both commercial and consumer without triggering the troubled debt restructure requirements that are enforced by financial regulators?
So there have been discussions. There has been guidance for, some relatively limited period of time that banks could engage in that type of activity with their borrowers. I think we're going to have to see how everything plays out. It's very important that the banking system play an important productive role for the U.S. economy. We are funneling a lot of the fiscal activities through the banks, through the Paycheck Protection Plan. The banks are extending those loans guaranteed by the SBA. Through our Fed lending programs, we are designing them so that the banks can go out and originate those loans, which then could be put to us in certain cases, and we try to facilitate that. So it's very important that the banks have that capacity, and the supervisors and regulators have to have those discussions with the banks to make sure that they can do that, and that they're safe and sound, and that the American people are protected in all regards.
Sure. So I know you touched on inflation briefly a few minutes ago, a couple of questions ago, but here's another one more specific to that. So any thoughts on inflation in the coming years as we come out of this? And will there be additional costs to provide the same level of products and services? Things like food price increases, assuming few people will be able to fly on a plane, driving prices up, increased prices on services to pay for cost of service, et cetera.
Well, I do think that, I think it's unlikely that we're going to see a substantial increase in inflation over the next several years. I think that it's certainly possible that given the supply constraints, supply chains are hurt. You can imagine certain products being more expensive, and that could lead to, higher prices and, that contributing to parts of inflation being measured higher. But it's also the case that the demand for all goods and services is going to be lower in a period of 14.7% unemployment, depending on how we get the economy back to work and households with reasonable income prospects. That reduces inflation pressures dramatically. And so I think those demand factors are going to be much more important for quite a long period of time. Certainly energy prices are a lot lower with the glut of oil supply. So, for the time being, I don't see rising inflation as much of a problem. And it's also the case that long-term interest rates are really low. And if investors were really concerned about rising inflation, they would be demanding higher nominal compensation through higher long-term interest rates. So we'll have to be paying attention to that, but I'm not really concerned about that. And I think getting the economy back on its feet, as many people working as is possible, is just very, very important. And so even if we saw inflation rise above what we've seen in the last many years, which frankly I would be hopeful for, that would be good. We've underrun our 2% inflation target for quite a long time. If we got up to 2.5, that would not be a problem at all. I just don't see that happening anytime soon.
Sure. Hopefully you have time for maybe just a couple more questions. So during the Great Recession, we learned how much of an impact the housing industry had on the national economy. Any predictions for housing? And what are your thoughts about oil market right now? How will that impact our economy?
It all comes back to, how strong is the economy going to be? What's the level of employment? I definitely think that people are going to want to continue to own their own home whenever possible. I think that, construction is something that can take place safely, as long as people are careful about, masks and social distancing and testing. So I think that can continue to take place. And mortgage rates ought to be attractive with low interest rates where they are. But of course, you got to balance that against income prospects and employment. So, it comes down to making sure we keep the economy going, more people get back to work when it's safe as soon as they can. And I think housing will contribute potentially strongly to the recovery if that's the case.
Yep. So last question here, and we'll let you go. So thinking about unemployment, and clearly we're going to see it continue to rise. And I think I've seen some numbers nationally now that they say it probably is topping 20% or there. It could here in the second quarter. How do you look at the second half of our year, and what type of barometer is the unemployment level, and how do we assess that with the economy, if we can kind of tie that all in together?
Yeah, it's really a great question. It's particularly challenging because this is a economic downturn unlike one I can ever remember studying about, not just post World War II, but ever. It's one where, because of the infectiousness of the novel coronavirus, because we didn't have immunity, all of the public health safety experts said we need to close things down. Everybody needs to, stay at home in order to reduce the spread and try to flatten the curve so that the health system is not overwhelmed. By doing that, you shut down literally the economy for some number of months. And how long is that going to be? What we are seeing, we saw unemployment insurance claims go up to 33 million people at one point have filed. The unemployment rate has gone up. The official number was 14.7%. Some people answered the question that they were still employed, but they weren't at work. They could have been measured as unemployed. It could have been over 20% if that had been the case. But we do expect that in the second half of the year, businesses begin to reopen. They call back workers. And if the same businesses are around, if demand is good, if they can call back the same workers, you could almost get everybody back to their previous job. Of course, if there are bankruptcies, if the business isn't there, then that doesn't work. If it takes too long and people start moving around to jobs, then the search process makes that longer. It's very important that we get the public health safety issues solved in a controlled fashion so we can get back to work safely. If we can do that, we do expect the unemployment rate to come down, quite sharply this year. By our forecast, the second half of this year should grow, quite well. And I expect the unemployment rate to come down to about 9% at the end of the year. That's a high rate. And the key is, will it continue to go down to, say, 5% by the end of 2021? That would be getting through this in a pretty good fashion, quite a downturn, very painful, but you can imagine going forward in a pretty reasonable fashion. Anything that slows this down, anything that leads to a second or third wave where we have to shut down wide swaths of the economy would be a much worse scenario. So I think the public health safety question is fundamentally the most important one, and then getting people back to work safely in that environment is key. That's how it's gonna, those are the issues. And, I'm hopeful that we'll get unemployment down by the end of this year.
Thinking about that by the end of 2021 and having it at 5%, that's still a full 1.5 above, I think, where we were, pre-COVID. So still pretty significant increases. One last question, and so second, if the impact comes back this fall, do you see the national economy and the states going to the extremes they did and kind of shutting down the economies the second time around? Have we learned enough here in what we're going through right now and how we safely reopen business and the economy?
I'm optimistic that even if, Dr. Fauci said that there would be second waves, that there would be, reinfections, hopefully at lower levels, hopefully that would not overwhelm the health system. I think that if testing is more available, if you can then identify, people who need to, be quarantined, stay at home, and, we get the virus spread down, that would be enormous. I think wearing masks is really a big part of that. If you go back and study the 1918 pandemic, when they had the second wave, when people didn't want to wear masks, then you got the same level of deaths in San Francisco the second time around as they did the first time around. So I think that that's important. Even if you wear, by one study I saw, even if you wear something that's not a fully effective mask, but you have a large number of people who are wearing it, like 80% wear it, 60% effective, you could get the so-called R0 reinfection rate down below 1, which is what everybody's hoping for. So I think that, more emphasis on public health safety, doing things which are annoying, not really what anybody wants to do, but if we could do that for some period of time, I think we could get on top of this and it would be, much better for the economy.
Great. Charlie, thank you so much for your time. We certainly appreciate you spend some time with some of our top business leaders here in the region this afternoon. So take care, stay safe, and we'll hope to see you maybe back in Lansing sometime at an economic club in person sometime here in the near future.
Thanks very much. I really hope to do that. It's great to be here virtually, but, I do look forward to the day when I can get back to Michigan and in Lansing to meet all of you again. So thanks very much.
Thank you. And I want to thank all of you for taking some time as well and joining us, and hope everyone has a great rest of the day. Thank you. Bye, Charlie.
Bye.